All right. Thank you, everyone, for joining me this afternoon. Welcome. My name is Tony Zhang. I run the product strategy team here at Options Play. And today we're going to be talking about generating consistent income using weekly options. So we'll be covering everything from what are the best practices when you're selling options for income, and what are the findings that we have from all the back tests that we've done to give you an idea as far as what works, what doesn't, so that you guys can take this and start applying it to your own trading. Can everyone hear me? If you can hear me, please type yes into the chat window. Okay, great. Looks like everyone can hear me. So on today's webinar, what I'm going to do is I'm going to cover how to utilize cover calls to generate income. However, I know many of you trade strategies outside of cover calls, but I'm not going to have time to cover things like short puts and credit spreads. But the things that we're going to teach you here today about how to utilize weekly options to generate income is applicable to all income strategies. So if you sell puts, cash secured puts, or if you sell credit spreads like call credit spreads and put credit spreads, what we're going to teach today here will be applicable for those as well. We're just going to be using cover call as a strategy to use because it is the basic strategy that most people are familiar with. Now, before I get started, I'm just going to launch a quick poll here. Just please answer the poll on your screen. I just want to get a feel for the users in this room, whether you've been trading options for a while or if you're brand new and just learning. Please enter that so that I have a feel for who's in the room. So far, 2/3 of you guys have voted. It looks like about 80% of you have been trading options for a while. About 20% of you are relatively new, which is great. For those of you that are brand new to options trading, this is options trading is not something you learn overnight, but Options Play is here to help you with that learning process. And I really hope that this webinar inspires you to take a look at utilizing options to generate some income in your portfolio, because this tool does make it a lot easier for you to explore and analyze these types of strategies, especially if you're a beginner. And I'll show you a little bit of the differences between using an option chain versus using using Options Play to help you find your income strategies. And for those of you that have some experience, which is most of you, this platform is really designed to simplify your life and make your trading a lot more efficient. So we'll show you how you can go from, once you set up the platform correctly for your personal settings, I'll show you how you can find these income strategies within just a few seconds, as opposed to having to scroll through pages and pages of option chains and doing analytics in order to find the right starting point. So that's what I'm hoping to give everyone here today. So whether you're brand new or experienced in trading, I hope you guys walk away with something really useful. So I'm just going to go ahead and end this poll real quick. So like I said, about 80% of you have been trading for a while, 20% of you are new. So for those of you that are new, I'm going to cover a little bit about cover calls, but I'm going to roll through this pretty quickly. I'm going to spend about 15 minutes using the slides to help educate you guys on kind of what are the best practices for income strategies when it comes to selling cover calls. But like I said, again, it can be applicable to shorting puts or other types of strategies. And what I really want to spend most of the time here today is showing you guys Options Play. That's the platform that you guys have access to. That's the platform that's designed to make your life easier. So what I really want to do is make sure that everyone leaves this webinar today feeling confident that they have the tools to implement what we teach today using Options Play. So you're not taking what we've learned, then having to take the time to learn it and then apply it to your own trading. I want you to be able to leave today with the tools and start applying this to your portfolios immediately. So just a little housekeeping, this webinar is recorded, and because there's quite a bit that I cover on the slides, I highly recommend for those of you that are watching this or newer to these types of strategies to come back and watch a recording. I'll send that out later tonight once we have the recording done. Take a look at what we cover in the slides, which I'll include the slides in the email, so that you understand the best practices before you start applying these in your own portfolios. So today what we're going to cover is, number one, what is a cover call? why you should consider using cover calls, how to generate consistent income using weekly options. And again, this is not just cover calls. You can apply them to puts and credit spreads, but we're going to use cover call as our example. Then we'll look at how to utilize options play for this type of strategy. Like I said, that's the bulk of the time that I want to spend is showing you how to use our platform with some real trading examples, implementing the things that we teach today. And then lastly, what I'll do is I'll end this with looking at some exit strategies, because we usually have a lot of questions. Once you're in one of these strategies, how do you actually exit them? So I'll cover a little bit about the different scenarios and how to take advantage or how to deal with each one of those scenarios. So let's just start off real quick for those of you that are brand new. What is a cover call? The cover call is by far the most popular strategy amongst options traders. About 40% of all trading volume across the 40 different strategies that you can trade, 40% of it is in this one strategy alone. So it's the bulk of options strategies that people trade. And the reason it's so popular is because a cover call is simply where you take your current stock position where you own at least 100 shares of that stock, and you sell a call against that for some income. So many of you already have this position here on the left. You own stock in your account. Whether you hold on to it for a while or you're trading in and out of them, many of you have at least 100 shares of some stock in your account. And that's why it's such a popular strategy, because you can sell a call against that stock that you own and generate an income by selling. And that's what a cover call is. And especially for those of you that are long-term buy and sell investors, the stock that's sitting in your account, you should utilize that to generate some income. And that's really what we're here to discuss today, is how do you utilize options to generate income for your portfolio. So let's take a look at why you should use cover calls. It generates consistent income in your portfolio. And this is true for all income strategies, not just cover calls. It lowers the volatility of your portfolio and the net cost basis of the stock that you own. And it's typically used on the existing stocks in your portfolio, meaning you don't have to buy anything new. You don't have to add any additional risk to your portfolio. You can generate income using the existing assets that are sitting in your brokerage account today. The limitations of this strategy is that it does limit the upside return of the stock that you own. So that's why it's really important to make sure you understand what are the criteria that you should use to select the right income strategies for your portfolio. That's what we're going to cover today. It does require at least 100 shares of the stock. So if you have some stock that you only have 50 or 80 shares of, this is not a strategy that you can deploy. And lastly, you do risk losing your stock. So it can become a taxable event depending on the type of account that you have. So make sure you're aware of that before you get into a trade like this. So what I really want to cover here is, how do you generate consistent income in your portfolio? And the answer is actually quite simple. But before we get into how to do that, I think it's really important for everyone to understand is that these types of strategies to generate income is not a one-size-fits-all strategy. So it's really important to understand what your personal preferences are so that you can select the appropriate options to sell for income. And that's really what we're going to learn today here, is what are those settings and how does they affect, your expirations and strike prices. Once you understand that, it really comes down to constantly using the same methodical approach every single month or every single quarter or however often you're doing this, and picking the suitable expiration and strike price based on what we learned here today. So it's really simple, is learning what your personal preferences are and sticking to those personal preferences month after month, quarter after quarter. That's how you gain consistency. It's really that simple. So we're going to jump right into it here. So when you're selling any option for income, there's two things that you need to select: an expiration date and a strike price. So let's cover expiration dates first. You can choose expiration dates anywhere from 1 week out to some of them are listed out as far as 3 years out. So where do you actually choose your expirations? So your expiration selection, or how far out you choose, should be based on how actively you trade. So I've created 3 buckets here. We have active traders. So this is traders like myself, someone who has the opportunity to look at their accounts pretty much on a daily basis or every couple of days. you would fall under the active trader category. For those of you that are on the other end of the spectrum, if you buy and hold your stocks, maybe you look at your portfolio once a month or once a quarter, you would fall into the long-term category or buy and hold. And then most of you will probably fall somewhere in between, or some of you will fall in between here, what I call casual investors. So you might look at your portfolio once every week, once every couple of weeks. You would fall under the medium-term category. So before we move on, just make a mental note to yourself. Which category do you think you fall under? Because it's going to help you determine which expirations you choose when you're selling options for income. So if you're an active, we typically tell users to sell short-dated options, so anywhere from 3 to 7 weeks out. So this is where we're utilizing a lot of those weekly options to be able to trade these shorter dated options. For those of you that are in the medium term, so anywhere from 50 to 89 days, so about a month and a half to about 3 months out. And for those of you that are long term, you want to sell options that are anywhere from 3 to 6 months out. Okay, so make a mental note to yourself before we move on. Which one of these categories do you fit under? Because that's going to help you determine what is the right expiration for you. So what I do want to point out a little bit is understanding what the difference is, because I want people to understand what you're trading off when you're selling short-dated options versus when you're selling long-dated options. So when you're selling short-dated options, so options that expire from a few weeks to like 3 to 7 weeks out, what you have is you have more certainty. What I mean by that is when you're looking at a stock going 3 to 7 weeks out, you generally have a pretty good visibility into what might happen, meaning corporate events, things like dividends, earnings dates, product launches. These are the types of things that 3 to 7 weeks out, you usually have a decent amount of visibility into. So you have more certainty as to what may happen between now and that expiration date. So what that means is that you get less income. But however, if you go further out, so if let's say you sell a 3 to 6 month option, there's a lot less certainty into what may happen in the next 3 to 6 months. There's earnings calls, there's dividends. You don't even know necessarily when the next earnings call may be when you're selling that far out, or the second earnings dates. So there's a lot of things that are kind of uncertain. So what that means is that you're going to get more income. So the further out in time you go, the more income you're going to receive, because you have this large uncertainty factor built into your option. So what I wanted to do is show you guys, based on all the back tests that we've done, we've tried selling covered calls on short dated options. We sold covered calls to long dated options, and we wanted to show you kind of what our findings have been. And the answer is, based on historical performance, it's best in terms of performance to sell shorter dated options. And there's two primary reasons for this. Number one, when you're selling covered calls or any type of option for income, your biggest shock or the biggest cause for underperformance is usually due to earnings, when you have these large moves on an earnings call. So when you're selling 1 month calls, you can do that 12 times a year. So that means that since there's 4 earning cycles a year, about a quarter of the trades that you do have this large uncertainty factor built into it, or the earnings cycle. However, if you're doing long dated options, so if you're selling 3 month options, you can only do that 4 times a year. So basically every single call you sell has this large uncertainty factor built into it. So that's why we generally prefer selling short dated options, because we can avoid the months where there's an earnings call and actually still be able to trade 75% of the time. Versus if you're doing long dated options, you don't really have a choice. You're going to have to take that large uncertainty factor built in. That's why it's generally preferable to trade shorter dated options versus longer dated options. The next thing is, the premium that you receive is not linear to the time. So if you go 3 times further out, so when you're selling a 3 month call versus a 1 month call, you're going 3 times out in time, but you're not going to get 3 times the amount of income. So a lot of times when you're selling a 3 month call, you're only going to get twice the amount of income that you would get from selling a 1 month call. So you can actually sell a 1 month call twice and receive roughly the same premium as someone who's selling a 3 month option. So you can actually sell 2 1 month options and then avoid the third one when there's an earnings call, and still make roughly the same amount of premium as that person who sold a 3 month call. So that's why for all of these reasons, it's generally preferable to trade shorter dated options versus longer dated options. Now, that doesn't mean for those of you that are buy and hold investors that you shouldn't trade long-term options. You should still do that. Just understand that from a performance perspective, you do have the highest performance when you're selling shorter dated options. Next, we're going to look at strike selection. So how do you select your strike prices? Now that we've understand how to select your expiration dates based on how frequently you trade, let's take a look at strike selection. Your strike selection really should be pegged to your risk tolerance. So, and I have 3 risk tolerances here up here. I have conservative, optimal, and aggressive. On the conservative end, this is for those of you that are selling cover calls that do not want to risk losing your stock, meaning you have a low risk tolerance for losing your stock. So either you've owned the stock for a long period of time, or perhaps it's a dividend paying stock and you rely on that dividend for income. So you want to make sure you hang on to that stock. If that's you, you would fall under the conservative end of the spectrum. On the other end of the spectrum, for the aggressive traders, this is for those of you that are really chasing yield. You don't mind losing the stock. It's okay if the stock gets called away. You're okay with that. So you want to get more aggressive. And then for most of you, you would probably fall somewhere in between, an optimal. So that's myself. I'm not too aggressive. I'm not too conservative. I prefer to find a nice balance between risk and reward. So before we move on, make a mental note to yourself again, which one of these 3 categories do you think you fall under? Because if you're a conservative trader, you generally want to find very high strikes or strikes that are very far away from the current price. So for those of you that are familiar with delta, this is something like a 10 delta call. So a call that has a relatively low chance of it being in the money. And we use an indicator called the probability of expiring worthless. That's just the inverse of delta, essentially. It's telling you what is the probability of a call or a put expiring worthless. So when you're a conservative trader, you want to shoot for a very high probability of that call expiring worthless. For optimal, you want to choose a 20 delta or an 80% chance that this call is going to expire worthless. And for aggressive, you might want to choose something around a 30 delta or about a 70% chance of expiring worthless. So let's look at these 3 and what do they actually mean. So when you're choosing a conservative one, we talked about this is choosing a strike that's very far out of the money, so a very high strike when we're talking about covered calls. And what that does is it gives your stock a lot more upside to move before the stock gets called away. And when you're trading a very aggressive call, you're trading a significantly lower strike price or strike price that's very close to the current price, which gives your stock less upside potential. And the relationship between these 2 is that the higher the strike, the less income you get. The lower the strike, the more income you get. So what we also want to do is then we wanted to backtest these different strike prices and say what type of returns can we see from these types of strike prices. So based on a bunch of backtests that we've done, so we backtest all S&P 500 stocks over the last 10 years. And what we basically saw is that you're better off on the more conservative end of the spectrum when it comes to selling these cover calls from a performance standpoint. And the reason for this is because all income strategies, whether you're selling covered calls, short puts, or even credit spreads, your reward is limited to the premium that you're collecting. So meaning your potential reward is limited. However, the lost opportunity or the downside is unlimited. So when you're selling a cover call or if you're shorting a put, the stock can go way above your strike price or way below your strike price, and that would result in substantially larger losses. Now, with a cover call, you don't have any losses because it's hedged with the long stock that you have, but there is lost opportunity there, and that lost opportunity is unlimited. So that's why the most important thing when you're selling these options for income is that giving your stock room to move is more important than collecting fatter premiums when you're selling these options for either calls or puts. So that's one of the key things about understanding income strategies is because your reward is limited and your downside risk is potentially much larger. It's always better to give yourself a little bit more room to trade, a little bit more room for the strike prices that you choose. So now that we've looked at how to choose the expiration date and how to choose the strike price based on how frequently you trade and your risk tolerance, let's take a look at how do you determine am I getting enough yield for the call that I'm selling or the put that I'm selling? And the answer that I always tell people is you want to compare the yields on a cover call or a short put or any of these strategies to the dividend yield. Use the dividend yield as your guide to determine, am I getting enough yield for the risk that I'm taking? So I have 3 examples here. If you are looking at a stock or a option strategy where you're receiving 3% yield on the covered call, and it's on a stock that pays a 1% dividend yield, that's kind of your best case scenario, because you're increasing your yield from currently 1% from just holding the stock to 4% by adding a covered call. So you're increasing your yield 300% by adding a covered call. That's the type of strategies that you typically want to look for, or the most attractive strategies to look for when you're selling your covered call. Here in the middle, I have where your dividend and your covered call yield are matching. So this is kind of your neutral, or what the minimum threshold that you're looking for is if you have a stock that pays a 3% dividend and you're looking at a covered call that pays a 3% yield, this is what your bare minimum that you're looking for in terms of yield in order to be worth taking that risk. And lastly, I have an example here where you're looking at a covered call that only gives you a 1% yield on a stock that currently pays you a 3% dividend. This is the type of strategy that you would typically want to avoid, because you're not adding enough yield to your stock in order to be taking the risk of potentially losing that stock. So use the yield on whatever income strategy that you're using, compare it to the dividend yield, and that's typically what you want to at least strive for when you're deciding whether you're getting enough income or not to be taking the trade. So just a quick snapshot or a quick summary of what we talked about. When we're choosing our expirations, it's better to prioritize certainty over premium, meaning having visibility into what may happen between now and expiration is more important than trying to get just larger premiums. And when you're selecting your strike prices, giving your stock room to move so that the stock takes off, you can still participate in that capital appreciation. That's more important than collecting an extra 10 or 20 cents by selling a more aggressive strike price on your covered calls. So based on all of that, what we've basically found from our backtested results is that choosing expirations in the short term, so anywhere from 3 to 7 weeks out, is generally preferable for performance. And in terms of strike prices, as this is a general rule of thumb, this is not saying for any individual stock, roughly the 15 delta call, so somewhere in between optimal and conservative, gives that nice balance between giving your stock upside return, but also receiving enough income to be worth your while, meaning you're still getting enough yield to beat that dividend yield. It is usually around the 15 delta call that we're seeing the best optimal results, if you will. And based on all of this, we're seeing a performance of somewhere roughly 3.4% annualized return on top of the stock returns that you're currently getting by using these types of strategies with your cover calls, okay? So what I really want to do, like I said, is I want to spend the time using options play to show you some real examples of how to do exactly what I'm telling you. So for those of you that are new to options play, this is the tool. It's divided into 3 sections. You have trade ideas and watch lists here on the left. We have our security analysis panel here in the middle, and we have trading and income here on the right. I'm not going to spend a lot of time going over the platform here today because we've done videos specifically for that. What I really want to point you guys is to 2 features. Number 1, the watch list feature. So for those of you that are either selling cover calls or selling puts or selling credit spreads on the stocks that you're watching, I highly recommend you to create a watch list for those stocks. So if you are selling cover calls, create a watch list for all the stocks that you own at least 100 shares of. This is going to make your life a lot easier once we go through the income tab. Okay, and for those of you that are selling puts or other credit spreads, you should also put in a watch list for the stocks that you're interested in doing those income strategies for. On the right-hand side, like I said, we have trading and income. Trading is really for those of you that are looking to speculate on direction. So if you're bullish on Apple, it'll show you 3 bullish strategies on how to take advantage of a bullish move on Apple. If you click on I'm bearish, it'll show you 3 bearish strategies. So you can type in any stock, click on I'm bullish or I'm bearish, and we'll present to you strategies that make sense as a starting point. But today, we're going to focus our time on income. This is designed, like I said, for those of you that are selling covered calls or short puts, and you can also use these strike prices to help you determine where to sell your credit spreads for those of you that are selling credit spreads. So On the income tab, before we do anything, the first thing you want to do when you're setting up your platform, if you're brand new to this platform, is there's a button here at the bottom called income settings. You want to click on that, and this is going to go over the two things that we talked about: expiration selection based on how frequently you trade, and strike selection based on your risk tolerance. So this allows you to set those settings that we just talked about. So if you remember back on the slides, I said that there's short, medium, and long term. I fall into the short term because I'm a fairly active trader. So I would select short term here for time frame. And for risk tolerance, like I said, I'm not too conservative, I'm not too aggressive, I fall somewhere in the middle. So I choose optimal. So make sure that you select the correct time frame and risk tolerance for your own personal preferences, because that's how you're going to be able to get consistency, is using the settings that make sense for you all the time. Okay, and I just want to show, for those of you that are newer to options trading, or even for those of you that have been trading for a while, this is compared to using a chain, right? So when you're using a chain, you have to remember, hey, I'm looking at short dated options, so I got to look at the Aprils because that's about 1 month out. Then you have to know that, hey, I'm optimal, so I'm going to select the 20 delta calls. Then you have to find the 20 delta calls. Then you have to see how much they're trading at. Then you have to calculate yield. We do all of that work for you, okay? So let me just go back here real quick, sorry. When you select your short-term and optimal settings, and you can do this for calls and puts separately. So for those of you that like to sell cash secured puts, you might want to get more aggressive. So when I sell cash secured puts, I like to get more aggressive. So I can create those settings separately for calls and puts. And once I do that, I can save this as default. And now I can click on any stock in my watch list and immediately see if there's an income opportunity available on the stocks that I'm looking at. So here's Walmart, and what I'm going to do is I'm going to walk you through as many of these examples as possible. If you click on yes for if you own shares of Walmart, this is for those of you that are trying to sell covered calls. You can type in the number of shares that you own. So let's say you own 300 shares of Walmart. It will tell you exactly where your ideal starting point is based on your short-term optimal preferences. So here it's telling me to sell the April 6th 92 covered calls. So as you can see, this for those of you that are brand new, explains the strategy to me in plain English. So this is telling me to sell the April 6th 92 covered calls. It generates $123 in premium or income. They produce a 7.37% annualized return. So I don't have to calculate this. It already tells me what the annualized return on this call is. And it tells me that there's a historical volatility of 80%. Based on historical volatility, there's an 80% chance that this call is going to expire worthless. So we talked about using a probability of expiring worthless, or delta, to help us select our strikes. So it does all of that work for you and presents it to you in an easy to understand format. So Walmart currently, if you own this stock, pays a 2.3% dividend. This is the stock that I own. It's a decent yield, but if I wanted to add some yield to it, I can sell covered calls and add an additional 7% to that. That brings my total yield to 9.73%, my 12-month projected yield. That's why these types of strategies are the most popular strategies to generate income. Especially if you already own the stock, you might as well consider looking at adding some additional yield by selling covered calls in it. And this tells you exactly where to start, what your yield is, so you can quickly decide, is this a trade that I want to make? If it is, you can click on the trade button. What we do is we give you all the details on how to enter this trade directly into your broker's platform. And we have what's called a strategy checklist. This is designed for those of you that are brand new to make sure that you avoid some of the costly mistakes that beginners tend to make. So probability of expiring worthless, we check to see that it's good. We check to see the annualized return. We check to see if there's earnings between now and expiration. We talked about how earnings is one of the largest contributors to downside performance in this particular type of strategy. So it's important to know, is there earnings between now and expiration? And lastly, we look at spread and liquidity. So we look at how liquid this trade is. So for those of you that are brand new, options liquidity may not be something that you might think about when you're trading stocks, but it's certainly something you want to be cognizant of when you're trading options, to know how liquid something is, because that's something you want to know before you get into the trade, not while you're trying to get out. You can't get out because the option's not very liquid. Okay, so what this does is it allows me to very quickly type in any stock, any stock that I own that's on my watch list, and within a few seconds know exactly what the ideal starting point is for both cover calls. So here on Lockheed Martin, it's telling me to sell the April 6th 347.5 cover call. This stock's trading at 333. So this is a strike price that's about $14 out of the money, so $14 above the current price. It expires in 23 days. So as long as the stock stays below 347.5 over the next 23 days, I keep this $125 in income, which is roughly a 6% yield on a stock that currently pays a 2.4% dividend. So I'm almost doubling my yield, or more than doubling my yield, by adding this cover call to my portfolio. And I can just go on very quickly on every single stock that I own here for Amgen. It's trading at 189.75. It's telling me to look at selling the April 6 200 cover calls. This is a stock that's trading at 189, so this is roughly $10 out of the money in the next 23 days. And there's a 7.53% yield on a stock that pays a 2.7% dividend yield today. So this is the type of strategies that you would typically want to look for when you're trying to add yield to your portfolio. And for those of you that are selling puts, you can click on no, and that will bring up the short put opportunity here. So if you're looking to sell a cash secured put, like I said, my settings are more aggressive on the puts. So this is telling me to sell the April 6 185 puts, so about $5 out of the money. And there's a 14% yield on this call because it's very aggressive, so I'm going to get a higher yield. And as long as the stock stays above 185, I keep the $169. If it goes below 185, then I effectively own the stock at 185. So this is really a strategy for those of you that want to own Amgen, but you don't want to own it at the current price. You want to own it at a lower price. So selling puts is a great way to potentially get into a trade without and generate some income while you're doing this. This is a way that you can potentially dollar cost average into a trade. Let's take a look at some other examples here. Let's look at Facebook. I want to look at Facebook because this is a stock that many of you own in your account, and it's currently a stock that pays 0% dividends. So if you own the stock, you're getting no yield today. It's currently trading at 181. So this is telling you to sell the April 6 192.5 cover call. So that generates about a 10% yield in the next 10% yield on a stock that pays you 0 yield today. So this is exactly the type of strategies that you might want to look for if you have stock in your account that's not generating a lot of yield and you want to generate some income on the stocks in your portfolio. And you can see how quickly I can go through a list of my stocks and very quickly within a few seconds know what is the ideal opportunity to start with. So here it's telling me to look at the April 677 cover calls on Exxon. And I can do this for a list of 20, 30, 40 stocks and within a few minutes know all the stocks where there's an income opportunity and all the stocks where there isn't. Now, here's an example where Ford, as you can see, instead of getting the green check mark that I got before, I get this blue-red warning signs telling me, basically this is telling me that it could not find me a cover call based on my short-term optimal preferences, and it's displaying to me the next best possible alternative, which in this case is a long-term aggressive. So this is really helping you guys save time, because if you've ever sold a covered call, many times you might scroll through this page, pages and pages and pages, and you might find that the Aprils doesn't have enough premium, so you end up going out to the Mays to see if there's enough premium. So number one, by doing that, you're not getting consistency because you're straying away from your normal strategy. And what you end up doing is you're just simply trying to search for yield that may not be there. And sometimes you end up going to June, July, and just realize, hey, there's just not enough premium in this stock to generate yield. And that's a lot of time that you end up wasting. Options play avoids all of that because it immediately tells you, hey, we could not find a cover call based on your personal preferences. So on Ford, I would immediately move on. I don't have to waste any more time trying to find a call that doesn't exist on a stock. And I'm just going through as many examples as possible, and I hope I'm not moving too fast for many of you, but that's why this webinar is recorded. But I do want to show you how quickly I can type in a symbol. For example, for Coca-Cola, I'll know that there is not a cover call opportunity here for me, but there is a short put opportunity, so I can see immediately, is this a trade that I want to look at? If not, I might move on. So look, if you wanted to look at this May 18th 47 cover call, this is a stock that currently pays me a 3.5% dividend yield and this cover call only gives me a 2.77% annualized return. So I can't even beat the dividend yield. So all of these things just tells me that I should not be selling cover calls on Coca-Cola. And I can know that without having to search for anything or pull up a chain. I just click on it and it tells me exactly what the opportunities are. So you can see how I can pull up a watch list with the stocks that I own, click on them once I have the income settings, and know immediately where it is that I want to place a trade. So here on Gilead, it's telling me to sell the April 6th 85.5 call. This stock currently pays a 2.8% dividend yield. This is telling me to sell a call that's roughly $3 out of the money, and it generates a 6.8% yield, which clearly beats the dividend yield that I currently have. And this is exactly the type of information that I need at my fingertips to immediately decide, is this a trade I want to make? So we talked about how can we use this platform to tell you within a few seconds whether there's an income opportunity or not. This is exactly how, okay? And I do want to place one last bit of information here is sometimes you may have certain stocks that you've held on to for a while that you don't want to lose. So especially those of you that may have held on to stocks like Microsoft or IBM and you've had them for years or maybe even decades, and you want to make sure that you don't lose this stock, I do want to show you, we have a thing here at the bottom called the options grid. So this is where you can actually make fine adjustments. So for example, if for IBM, instead of using optimal, you want to do conservative, it'll show you the different strikes so that you don't have to pull up that whole chain just to change or make some adjustments. So you can go longer term, you can go more aggressive, more optimal, or more conservative. It's all available here. So the 165s are the optimal strikes. It'll tell you that if you want to be conservative, you can sell the 170s. If you want to be aggressive, sell the 162 and a halves. This is all designed to give you a bigger picture without overwhelming you with a whole chain. Okay, so you can use this by clicking on the options grid button at the bottom of your income tab. So I've covered a lot here today. I don't expect everyone to memorize everything I do. So that, again, that's why this webinar is recorded. But I just want to sum up a couple of things. Number one, when you start out here, make sure you create a watch list with all the stocks that you either currently own or interested in owning if you're selling puts, or the stocks that you want to sell on. Set up that watch list. And when you come to the income tab, make sure you first put in your income settings. So it defaults to short-term optimal. So because that's based on all of our back tests, that's kind of the most general strategy that I think most people should start off with. But make sure you create your own settings. And once you save as default, you just simply have to tap on a symbol, and it will present to you the optimal starting point based on your personal preferences. Gives you all the underlying analytics to decide, is there enough yield on this cover call? And if it is, you just go ahead and hit trade, and presents to you all the details on how to enter this trade into your broker's platform. So with that, what I'm going to do is I'm just going to flip back to the slides. And then, like I said, I'm going to, at the end, talk about exit strategies. And this is just a very brief strategy, and you can use them for both puts and calls. You just have to inverse these, if you will. So when you're selling a cover call, there's essentially three things that can potentially happen. The stock can shoot substantially higher, the stock can go sideways, or the stock can go substantially lower. So I just want to look at each one of these three strategies and how to handle them. So the number one, you sell a cover call and the stock shoots up and goes above the strike price. This is where we tend to see a lot of people panic. And the advice here for you is don't panic. Hold on to your cover call, especially if you still have plenty of time left on the cover call. Hold on to it and roll it only if you have to in the last week, meaning if you want to hang on to that stock, you don't want to lose the stock, roll it only in that last week. This gives your stock potential time to come back down below the strike price, and it means that you're not locking in a loss and you're able to capture the actual time premium that you're trying to capture when you're selling a cover call. The only exception to this rule is really if it goes so far above the strike price that your call now goes to a 90 delta call, that's when it might be time just to cut your losses, buy back that call, and move on. In the second scenario, if the stock goes sideways, this is really kind of your best case scenario when you're selling a cover call. This is where you essentially want to hang on to your position, let it expire worthless, and come back the following Monday, put in your symbol into options play again, and sell another cover call. Lastly, if you sell a cover call and the stock drops, this is the only time where it makes sense to roll your position early. So, and the rule of thumb here is if you can buy back a cover call that you've sold for 20% of the original premium that you sold it for, that's when you want to buy it back. So if you sold a call for $1 and you can buy it back for 20 cents or small or less, take that trade, take that profit and sell another cover call, especially if you still have a bit of time left in the trade. So with that, that concludes what I wanted to share with you guys here today. I hope you guys have found this useful, and what I'm going to do is I'm going to open this up for Q&A. I see that there's a lot of questions already in there. I'll try to get to as many of these as possible. But if you have any questions, please type them into the chat window. Please type them into the chat window. It's just easier for me to do them all from here. Mark is asking, please explain when using a $10 stock price exactly what happens if your stock gets called away and you want to replace it, including cost. Well, Mark, one of the things is that if you don't want to lose the stock, you don't have to. Just buy back the call before expiration, and that's why you don't have to deal with replacing that stock. For non-dividend paying stocks like Amazon, what do you think about buying long-term in-the-money call and selling a short-term call? Great question. That's exactly what many, many people do, is instead of buying 100 shares of that stock, because some people just don't have the money to buy 100 shares of a high-priced stock, they'll buy a deep-in-the-money call, which effectively is the same thing as owning the stock from a cover call perspective, and you can sell calls against that long-term deep in the money call the same way you would for a cover call. A lot of people like to call it the a poor man's cover call. So absolutely, that's certainly a strategy that you can do. What is beta? I think if you're referring to beta, that's just a term that's used to measure how volatile a stock is compared to the overall market. A beta of 1 means it's as volatile as the market. A beta of 2 means it's twice as volatile as the market. I hope that's what you were asking. Tung is asking, does options play have setups for credit spreads? Absolutely. So for any strategy here on the trading tab, you can click on modify, and we have what's called a strategy constructor. So if, let's say you're bullish on Apple and you want to trade a credit spread, you can choose the short put vertical and set up a credit spread, and you can simply make the spreads wider. You can move all the strikes up and down one. Everything you can do on a platform, elsewhere, you can do here. And the great thing about our platform is it allows you to set up different credit spreads next to each other so you can compare them. So if, let's say, you wanted to look at the April 327, 337 and a half buy, and you want to look at different strikes, you can actually put them side by side and compare them and see exactly what your expected returns and losses are. You can use our P&L simulator to see how they perform, if the stock goes higher, if it goes lower, so you know exactly what the strategies are before you place a trade. But I don't want to get too far off track. Let's get back to kind of what we're talking about here today. William's asking, do you have a factor considered reduction in yield due to commissions? Unfortunately, that's not something we have built in here. So everything that we're showing you here is based on the pure cost of the option, because we don't know what your commission schedules at your brokers look like. Vincent saying, I did a buy right on Twitter today using your system. Yield is 17.45%. Great. That sounds like that's a pretty aggressive call to sell, but I haven't looked at Twitter recently. So it looks like, that's a pretty high yield, just because the implied volatility of the stock is probably pretty high. Spiros is asking, is this a strategy only if you own the stock? So yes and no. You can own a deep in the money call. So like the question before, you can own a deep in the money call, and that is one way to potentially, instead of owning 100 shares of the stock, you can buy, let's say, let's look at this. Instead of buying 100 shares of Twitter, which costs you $3,400, you can buy, let's say, a January 30 call, which costs you $1,000, so about a third of the price, and it gives you a similar risk profile to owning 100 shares of the stock, and you can sell calls against this long call. So you don't have to own the stock necessarily. Andrew's asking, can you explain the max risk and max reward of cover calls? The max risk and max reward is actually including the stock cost. So the max risk is essentially, if the stock goes to zero, you lose $3,300. That's assuming that you buy it at the current price. So that's all that is. Can you add 2 moving averages lines to the chart? Absolutely. So you can expand the chart, click on studies, and you can add moving averages. You can add as many as you'd like. You just have to click on the expand button, and there's the studies for that. Please explain delta. Delta is just an approximation for whether the percentage or the probability of the stock being in the money. So if you were looking at a Twitter call, a 34 call, if it has a 50 delta, that means there's a 50% chance that Twitter will be above $34. So if you have a 10 delta, that means there's a 10% chance that the stock's going to be above that current price. Where do you find open interest? You don't find open interest on our platform, and that's actually by design, because open interest is not a good gauge for really anything other than what other people have traded, and that doesn't really factor into anything. What we do is we use the bid-ask spread, the distance between the bid and the ask price to determine liquidity, and that's why we use the bid and ask price versus open interest. We actually don't look at open interest at all because it's not relevant to our trading. Paul's asking, can you do credit spreads with this? Absolutely. I just showed you guys how to do that using the modify and using the strategy constructor to do that. Please explain the sample roll down and buy back at 20%. So if, let's say you sell this Twitter trade for 62 cents. Let's find a higher price stock just for illustrative purposes. Let's look at Amazon here. So if I sell this Amazon call that it's going to tell me to do, Amazon's a big chain, so it'll take a second to bring up. So while I have that load, I'll try to answer the next question. How do you do in the money options with this system? Well, you can modify this and you can select any strike that you want. So you can select in the money, out of the money, whatever you want. But that's how you do it. You just click on modify and you can select whatever strike you'd like. So to answer the question about buying back for 20 cents. So if I sold this call for $1,000 and sometime later Amazon drops and this call is trading at $200 or less, so less than 20% of the premium that I've received, that is a good time to take profits, meaning buy back that call and sell the next call. This is really, telling you when to take profits on a cover call if the stock drops. So I hope I elaborated there on if the stock goes higher and if the stock goes lower, and if the stock goes higher, again, what I'm saying is hold on to this call. And if you need to roll this call because you don't want to lose the stock, wait until the last week before expiration. So today is the 14th. So if you sold this April 6th call and the stock shoots up next week, don't panic. Hold it on until about April, then roll it in April when you need to. So the last week before expiration. Paul's asking, what is the monthly subscription? So the subscription cost at Options Play is $50 a month or $500 a year. How do you interpret high-low beta in the context of options? You really don't. We generally speaking don't even use beta. It's pretty old measure used by Yahoo Finance and a few other places, but we usually don't factor that into when we look at options, to be perfectly honest. How do you roll over from Karen? It's really simple. All you're doing is you're buying back. So for this to enter this trade, you're selling to open, and to roll it, you're essentially buying to close this call that you've sold, and then selling the new call that you're selling. So that's what we refer to when we're saying rolling, is you're buying back the current call and selling the new one. And if you can do that in one single order, that's what we call the roll. Thomas is asking, managing live positions take time. Are you building capability to manage your options positions? Absolutely. So we're currently in the process of building Options Play portfolio. For subscribers, we have a portfolio preview for that. So it's a manual process to upload your portfolio, but we will provide alerts as to when it's time to consider rolling or even entering a cover call position. We are working on hopefully getting a real integration with some of the major brokers so that we can pull in your portfolios immediately. Miran's asking, do you look at the tech score when you sell cover calls? I almost do not. However, if you have a stock that's on a very strong bull trend like Amazon, where the technical score, you might want to move to a more conservative strike. Conversely, if you have a technical score of a stock with a very low technical score like Sprint, you might get a bit more aggressive. That's up to you. I personally generally don't let that determine that, because the whole point of options is what we're doing here is not directional. The strike selection does not have a directional bias built into it, but you can always adjust your own strikes depending on where you think the stock's going to go. I was a trial user of Options Play and didn't subscribe. Learn more today to get me interested again. Great. I really hope for those of you that are new to Options Play or new to options, I hope this webinar inspires you to take a look at options again, because there's a lot of value in what this thing can offer you and what options in general can do. I have a lot more questions here. I hope I can get to everyone here. What do the numbers in the circles mean? This is the Options Play score. This is just a risk metric. This tells you how much potential reward are you getting on this call versus the potential risk. As you can see here, I have very little green, so very little potential reward versus a lot of red, so a lot of risk. So that's why I have a low Options Play score. So this is just telling you how well balanced the risk to reward on any one strategy is. Would you suggest for a stock that has substantially declined where you would base the cover call strike price, example, US Steel? So again, this, cover calls is a strategy that you're supposed to do day in, month after month. So the swings that happen in a couple of weeks or a couple of days, you usually should not factor into how you do them. They typically happen in the middle of a cycle. So that's what I'm saying. If you get a large move up here, don't panic, because like I said, a few weeks later, it can come right back down. So that's why if you had sold the cover call here at the bottom and you sold the 42 call, on this day that it moved above that 42 call, you might have panicked. And all I'm saying is don't panic, because give it some time. Number one, you want to capture that time premium. Number two, you don't want to lock in a loss, because the stock may very well come back below your strike price. So don't let the swings of a couple of days sway you to decide to panic or get in and out of a trade. There are rules that you can use, and those are the rules that I talked about before. Are you considering provide lifetime quotas on your platform? I'm not sure what that means, Vlad. If you can clarify for that, that'd be great. POW, probability of winning? No, POW is probability of expiring worthless. So if I'm selling this 43.5 cover call on US Steel that's trading at $43, that's telling me there's a 76% chance that this call will expire worthless, or 76% chance I keep all that income. What is a favorite strategy you use most often? The cover calls is my number one strategy, and trading debit spreads is my second most popular strategy. That's for more speculation. On the poor man's cover call, it's a good idea to open the deep in the money call, expire longer days, and sell weekly calls. Yes, absolutely. So the long call on a poor man's cover call should be much further out, usually 9 months or longer. It leaps exactly, and you want to sell weekly calls against it. That's correct. How do you determine the exit point on a max profit and trading strategies? So that, I'd love to get into that, but I have specific webinars just on that. We've actually pre-recorded webinars on that. I'd love to get into that stuff, but I'm going to leave that for a different webinar. Is there a way for a scan for ideas that are 3 times the dividend yield as you mentioned? Because everything is calculated on the fly based on the current prices, we can't scan for them ahead of time. So we literally calculate these yields as you pull up these symbols, because we're pulling in the most up-to-date prices and calculating the yields. So unfortunately, we can't do that. Will the questions and answers be included in the recording? They are very helpful. I will do my best to try to include the chat into the what we send out today. I don't have, I usually don't do that, but that's a good feedback. I may be able to include that in the file that I send. Twitter is at 36. That's a good question. I'd have to look into that. You very well may be right. I'm not sure why we see that. Looks like it's having some trouble loading here. What do you mean by buying back at 90 delta when the stock is moving up? So if I'm selling this call, this currently call might have a 10 delta on Twitter. If the stock goes, if it goes up to 90 delta, so meaning the stock would probably have to go to $50 or maybe even $60 in order for that to happen. But that is usually a good rule of thumb to consider getting out of the trade. Best book on options trading. Ooh, that's a tough one. It depends on kind of how technical you want to get. There's lots of ones like options trading options playbook, which is really kind of for beginners. And then there's really technical ones like Options Edge. So it really depends on what type of trader you are. And they're all over Amazon. I would just simply read the reviews, and based on how technical you are, choose one. How do we use a system to find stocks to cover call? You don't. Cover calls is a strategy for the stocks you already own. You don't go out and buy a stock just to sell a cover call on. So that's why there's no system to find the stocks. It's only for the stocks that you own or stocks that you want to own. Great, Gary. I hope this webinar is helpful for you in understanding kind of what we do and how options can be useful for you. Mark is asking a long question regarding the commissions between 1 month and 3 month calls, and you're absolutely right. You're going to generate more in commissions depending, when you're doing 1 month calls versus 3 month calls. So that's where you have to do the calculations as to whether or not it makes sense for you. But from our usually you'll be able to receive more premium in doing 2 1 month calls. And by avoiding that 1 month, that's really the key thing. It's not the difference between 1 month and 3 month. The key is avoiding that third month where there's earnings. That is the key to this type of strategy. And that's why we suggest using shorter dated options. Spreads between bid-ask means volatile. So not necessarily. The spread between the bid-ask is referring to liquidity. So the more liquid something is, the tighter the spread. The less liquid something is, the higher the spread. Some trade shows options play log. Does that have any significance? I'm not sure what that question is. If you could rephrase that, I'd be happy to answer that. Sams, what is your advice on doing cover calls on weekly options? Well, that's exactly what we're talking about here, is using weekly options for your cover calls, because weekly options, number one, typically have a lot more strikes. So if you can see, I have half a 50-cent strikes on weeklies. A lot of times the monthlies have maybe $1 strikes or maybe $2.50 strikes. So that's why we generally prefer using weeklies, because you can find a lot more granularity and find the exact strike that you're looking for. What do you think about SPX for calls? So SPX is an index. It's cash secured, so you can't, it's cash settled, so you can't own SPX. So if you're selling naked calls or naked puts, there's a significantly higher margin requirements to do that, and it's a whole nother beast. You're typically trading SPX for credit. You're trading credit spreads. You're typically not selling calls and puts naked. So that's just a completely different strategy to what we're talking here today. Where do we find previously recorded sessions? So all of our previously recorded sessions are on our YouTube channel. So you can find our YouTube channel, and we actually have what's called a Learn to Trade series. So we've created a playlist that's already curated with all the most important videos that we think you should learn. So I highly recommend that you go on YouTube, find us there, click on subscribe, because that will mean that every single time we post a new video, you get an update to it. So I highly recommend you to do that if you are interested in learning about some of our other sessions, like trading earnings, finding your directional edge, and even just a full platform walkthrough for those of you that are brand new. Chris, the question about ALA, if you don't mind, can you please send me an email about that? Because that's a very specific question. I don't want to do that in the middle of a webinar. Is it a good idea to sell naked put of delta 10 or less? So that's completely up to you. So, if you're selling puts, you generally want to generate some income. A 10 delta is probably not giving you much income. It really depends on whether or not you want to own the stock. If you don't want to own the stock, then you may want to sell a 10 delta call. If you do want to own the stock, you might want to get a little bit more aggressive, like a 20 or 30 delta call. William, like I said, SPX, it's used for all sorts of option strategies, primarily for credit spreads, but that's just a different strategy to what we're talking about here today. I'm happy to answer those questions if you send them to me separately. Can you explain poor man's cover call again? Okay, I'll do this real quick. I don't have a lot of time, but basically what you're doing is you're buying a call. So let's say let's look at Facebook. If let's say you don't have the $18,000 to buy 100 shares of Facebook, but you want to sell cover calls, what you can do is you can buy a leap. So let's say you buy a January let's say a 150 call that costs you $4,300. So that costs you only about a quarter of the price of buying 100 shares. And by owning this deep in the money call, you have a very similar risk profile to owning the stock, and you can sell cover calls against it. So only for a quarter of the price, you can be long the stock essentially and still have the ability to sell calls against that. Some trades show options play logo. Does that have any significance? Oh yeah, absolutely. So if you have some trades that have an options play logo, that just means that it passes every single check on our strategy checklist. So as you can see here on this particular trade, there's 2 things that are red. So that means it doesn't pass all the things on our strategy checklist. If everything is green, that's when you get instead of a check, you get an options play logo. Do you avoid selling a call? Do you avoid selling a call in the earning month? Yes. So we generally tell you to avoid selling cover calls going into earnings. That's based on our historical backtests shown to give performance. I have a question here on U.S. Steel. Please shoot me an email afterwards. I'd be happy to take a look at the specific examples on that. Thomas is asking, Chaikin Analytics has options play capability. Is that the same platform? No, it is not the same platform. Chaikin is a great partner of ours. They've licensed a piece of our software for using it with conjunction with Chaikin Analytics, but it is a separate strategy. It is a separate platform, and it is a lighter version of options play. So you get some of our functionality, but not all of it. Okay, guys, it's been an hour, and this has been great. I hope you guys have found this webinar useful. I hope you guys have found everything that we're talking about here useful. I tried to answer as many questions as possible, but maybe I've left out a few. If I did, please just email us. I'm happy to answer any of your questions. But like I said, this webinar is recorded, and I covered a lot of things here today. So I really hope that you guys take the time, go through the recording, and you may have missed a few things, or maybe I went really fast on some of the things. So I really hope that you guys take the time, go through the recording, and I hope you found this useful, more importantly than anything else. And for those of you that don't have a subscription, if you're interested in using this, you can subscribe. We'll send you an email with how to start a subscription afterwards. I hope you guys, like I said, found this very useful. Thank you for everyone for saying thanks. This is really kind of why we do this. We want to make options a lot easier for everyone. We want to make it accessible to everyone, so it's not scary. And I hope we did that successfully here. So thank you very much. I hope you guys all have a great afternoon, and I will see you next week on our next webinar.